Most people see KYC as an inconvenience. Upload ID, take a selfie, wait for approval. But KYC isn't designed to slow you down. It's designed to protect the system. Today, we'll explain what KYC is, why payment platforms require it, and how it impacts virtual cards and global payments. KYC stands for Know Your Customer. It's a regulatory process used by banks and fintech platforms to verify a user's identity. Typically, it includes government-issued ID, proof of address, liveness verification, and risk screening. KYC is part of broader compliance frameworks like AML, anti-money laundering, and CFT, counter-terrorist financing. It's not optional for licensed financial institutions. Every serious platform must follow these rules. It ensures that everyone playing in the system is who they say they are. Payment platforms operate within regulated financial networks. Without identity verification, systems would be exposed to fraud, chargeback abuse, money laundering, and account takeovers. And synthetic identities. These are real threats that can collapse a payment network. KYC creates accountability. It connects transactions to real identities, which stabilizes the payment ecosystem. In short, no KYC, higher systemic risk. It's a risk no major platform can afford. In the virtual card space, KYC policies vary. Some providers offer simplified onboarding. Others require full identity verification. The level of KYC often determines your access. Spending limits and access to higher volumes, withdrawal rights, risk tolerance, and regulatory coverage. It's about matching the level of trust with the level of activity. The more scalable the usage, the more likely full verification is required. Different regions have different regulatory standards. Serious payment platforms must comply globally. EU, PSD2, and AMLD, US, FinCEN regulations, Asia, local AML frameworks. Serious payment platforms must comply. That's why KYC isn't a marketing choice. It's a legal obligation. In some cases, simplified onboarding can improve speed and accessibility, but there are trade-offs. Fully anonymous, high-volume payment infrastructure is difficult to maintain long-term. Users should understand that lower verification levels may result in lower transaction limits and stricter automated risk controls. Compliance is not about restriction. It's about building sustainable financial infrastructure. For businesses, KYC enables growth. It builds trust between users, platforms, and networks. Higher transaction thresholds, bank partnerships, stable routing, and reduced fraud rates. It builds trust between users, platforms, and networks. And trust powers payments. KYC isn't about restriction. It's about protection, compliance, and stability. In modern fintech, secure identity verification is part of professional payment infrastructure. If you're building globally, understand compliance. Don't avoid it. Build for the long term.